Good evening. This is a special broadcast, and I need you to listen very carefully. As of today, the clock is ticking. There are precisely 120 days until the end of April. 120 days for you to understand what is coming, to see the machine at work, and to position yourself not just for preservation, but for a generational transfer of wealth. By that date, I believe the price of a single ounce of silver will reach $150. It is not a speculative guess. It is the output of an economic equation that is now, as we speak, entering its final, most volatile phase. This is about the collapse of a world reserve currency. This is about the end of a 75-year debt cycle. And this is about what you will do before the final hour strikes. Let me tell you a story. A few months ago, I had a long conversation with a man I'll call Richard. Richard is a structural engineer. He builds bridges. He understands load, stress, material fatigue, and the precise mathematics of safety. He is, by every measure, a brilliant and prudent man. He had saved diligently, a portfolio of index funds, a paid-off house, a comfortable 401k. He believed in the system. He believed in the dollar. He came to me not for investment advice, but for an explanation. He said, "The numbers I use for my bridges are constants. Gravity is a constant. The strength of steel is a constant. But the numbers in my financial life, my grocery bill, my property tax, the value of my bonds, they're no longer constants. They are variables changing in ways that follow no law I understand. The bridge I'm designing now will stand for a century, but I am no longer confident my finances will stand for the next 5 years." Richard's confusion, his deep professional unease, is the canary in the coal mine. When a man who masters physics feels financially powerless, the system is sending a signal that most are choosing to ignore. Richard is not alone. You feel it too. You see it at the gas pump. You see it in your insurance premiums. You hear it in the strained tone of news anchors. Something is breaking, and tonight we will put a name to that break. We will diagnose it, not with emotion, but with the cold, relentless logic of the economic machine. To understand why silver will go to $150 and why the US dollar faces its most profound crisis, you must first understand the engine that drives all of history. Money, credit, debt, and the rise and fall of empires are not mysteries. They are cycles. They are mechanics. Imagine an economy as a simple machine with a few fundamental parts, transactions. That's the basic building block. Everyone is buying and selling something all the time, using money and credit. The total of this is what we call the economy. It's driven by three main forces: productivity growth, the short-term debt cycle, and the long-term debt cycle. Productivity growth is the slow, steady upward march of innovation and efficiency. It is the true source of rising living standards over centuries. But superimposed on this trend are the debt cycles. The short-term debt cycle, what we commonly call the business cycle, lasts roughly 5 to 8 years. We have a recession, interest rates are cut, credit becomes cheap, people borrow and spend. We have an expansion, inflation picks up, rates are raised, borrowing slows, and we have a recession again. You have lived through many of these. They are familiar, they are painful, but the system self-corrects. But then there is the long-term debt cycle. This is the cycle that spans a human lifetime, 50 to 75 years. It is so vast, most people fail to recognize it while they are in it. It begins in the ashes of the last debt collapse. In 1945, after World War II, the United States emerged with its industrial base untouched, holding the vast majority of the world's gold, and with the responsibility and privilege of creating a new global system. The Bretton Woods Agreement made the US dollar, backed by gold at $35 an ounce, the world's reserve currency. This was the dawn of our current long-term debt cycle. Debt was low. The world needed to rebuild. credit was extended in dollars. For decades, this was a virtuous cycle. The world needed dollars to trade, to build reserves, which strengthened the dollar, which allowed America to borrow more, which fueled more global trade. The dollar wasn't just our currency, it became the world's currency. But here is the immutable law of the long-term debt cycle. Debt rises faster than income, slowly at first. The promises we make in the form of bonds, mortgages, and government obligations gradually accumulate. As the cycle matures, the productivity gains slow, but the debt does not. To keep the party going, to avoid the short-term pain of a recession, central banks are tempted to lower interest rates and make credit easier each time the short-term cycle turns down. So, over 75 years, you get a magnificent, terrifying mountain of debt, with interest rates pushed all the way to zero. We reached this point effectively in 2008. When the short-term debt cycle crashed in the great financial crisis, interest rates were already low. The only tool left was to print money, quantitative easing, the creation of trillions of dollars out of thin air to buy financial assets and prop up the system. This was a profound turning point. It marked the transition from a credit-driven expansion to a money-printing-driven expansion. The long-term debt cycle was entering its final parabolic stage. We did it again in 2020, but on a scale that dwarfed 2008. In response to the pandemic, global central banks, led by the Federal Reserve, created more money in one year than in the prior 5,000 years of human civilization combined. The U.S. government ran deficits that were previously unthinkable in peacetime. This money flooded the system. Initially, it was trapped in financial assets, blowing up stock and bond and real estate prices. But then it began to leak into the real economy. You felt it. This was not a temporary spike. This was the system signaling that the relationship between the amount of money and the amount of goods and services it could claim had fundamentally shifted. The classic response to inflation is for the central bank to raise interest rates aggressively. But here lies the trap, the terminal crisis of the long-term debt cycle. The debt burden has become so enormous that raising rates to a level that would actually quell inflation, say 8 or 9 or 10%, would instantly collapse the system. Think of the U.S. government paying interest on $34 trillion of debt. At 1%, that's $340 billion a year. At 5%, it becomes $1.7 trillion a year. That is more than the entire national defense budget. It is mathematically unsustainable. So the Federal Reserve is in a box, a perfect trap. It must choose between containing inflation and destroying the Treasury market, or financing the government's deficits and letting inflation run. Which do you think it will choose? It will always choose the path that avoids immediate catastrophic debt collapse. It will choose inflation, because inflation, in a perverse way, is a political solution. It slowly erodes the real value of that $34 trillion debt. It is a silent, insidious default on everyone who holds dollar-denominated promises. It is a tax on savers, on cash holders, on anyone who believed in the stability of the old constants. This is the warning. The U.S. dollar is not going to vanish tomorrow, but its value, its purchasing power, is embarking on a steep stair-step decline. And when the world's reserve currency enters a managed decline, the entire global financial architecture trembles. This is what we face now, not a cyclical recession, but a secular shift, a change of regime. History does not repeat, but it rhymes. Let us look for the rhymes. The 1930s saw a global debt collapse and the end of the gold standard. The response was devaluation, protectionism, and war. The 1970s saw the end of the Bretton Woods system when the dollar's final link to gold was severed by President Nixon in 1971. What followed was a decade of stagflation, where inflation averaged over 7% annually and peaked near 15%. But here is the critical difference and why the coming period will be more severe. In the 1970s, the total U.S. debt to GDP ratio was around 150%. Today, it is over 350%. In the 1970s, the Fed was able to raise the Fed funds rate to nearly 20% to break inflation's back because the debt burden was manageable. Today, as we've established, that is impossible. In the 1970s, the U.S. was the world's undisputed creditor nation. Today, it is the world's largest debtor. Just the scale is different. The dynamics are more explosive. This is the 1970s on steroids, combined with the debt burden of the 1930s, playing out in a digitally connected, socially fragile global system. So, where does silver come into this? And why $150? Silver is not one asset. It plays three critical roles, and each role is about to be activated simultaneously. First, silver is money. For 5,000 years, across every culture, silver and gold have been the ultimate safe haven when faith in paper currency erodes. They are no one's liability. They cannot be printed. They have preserved purchasing power through every empire's decline. As the dollar's confidence game unravels, the flight to real money will be historic. Second, silver is a critical industrial commodity. It is the most conductive metal on Earth. It is essential for solar panels, for electric vehicles, for every piece of electronics you own. The green energy transition is a government-mandated, capital-intensive shift that will consume silver in quantities never before seen. We are adding demand of over 100 million ounces annually from solar alone against a total annual mine supply of roughly 800 million ounces that has been flat for years. Third, and most crucially, the silver market is tiny and fundamentally broken. The entire above-ground investment stock of silver, all the bars and coins in the world, is worth, at today's prices, perhaps $60 billion. That is less than the market capitalization of a single large tech company. The paper derivatives market, the futures and options traded in New York and London, controls the price, but represents promises for silver that are 100 times the physical deliverable stock. This is a paper pyramid built on a grain of sand. Now inject the catalyst, a loss of confidence in the dollar and a surge of inflationary fear. When institutions, hedge funds, and finally sovereign nations begin to move even a tiny fraction of their assets into precious metals for protection, they will quickly realize the gold market, while larger, is also tight. Their gaze will turn to silver. But the moment they seek to take physical delivery of even a modest amount, the paper market will shatter. The price discovery mechanism will break. The price on the screen will have no relation to the price of a real bar in your hand. This is a short squeeze of epic historic proportions. It is not about speculation. It is about the violent repricing of a vital, scarce monetary asset that has been suppressed for decades by paper promises. The math is simple. If just 1% of the tens of trillions of dollars seeking shelter moves into silver, that is hundreds of billions of dollars chasing a $60 billion physical market. The price must rise not by percentages, but by multiples. $150 an ounce is not a fantasy. It is, if anything, a conservative midpoint in that repricing. It is the market screaming that the old system of priced in dollars is over. What must you do? The window is closing, but it is not yet closed. You must restructure your portfolio from one designed for a world of stability and mild inflation to one designed for a world of currency debasement and regime change. This is not about getting rich. This is about surviving and then thriving. You must own assets, not dollars, but not all assets. You must own the right assets. Let me give you the blueprint. First, a foundational allocation to physical gold and silver. This is your financial insurance. It is the portion of your wealth that exists outside the banking system. I recommend 10 to 15% of your net worth. Of this, the majority should be in gold for stability, but a meaningful portion must be in silver for the asymmetric upside we just discussed. Own it physically. Hold it in your hand or store it in a non-bank, allocated, audited vault in a safe jurisdiction. This is your anchor. Second, you must own real assets. These are things with intrinsic value that rise with inflation. This includes productive farmland, timberland, and strategically located water rights. These are hard to acquire directly, so consider funds or specialized vehicles that give you exposure. This also includes energy. The world will run on energy, regardless of the currency. Own the companies that produce oil, gas, and uranium. They are not relics. They are the bridge fuels that will be desperately needed during this chaotic transition. Their pricing power will be extraordinary. Third, own Treasury inflation-protected securities, TIPS. This is a specific, non-intuitive play. In a world where the government is forced to inflate away its debt, TIPS are a contract that forces them to compensate you for that inflation. They are an admission of guilt, and you want to own that admission. As inflation expectations rise, these will outperform traditional bonds dramatically. Fourth, own what I call pricing power stocks. These are not the high-flying tech stocks of the last cycle, which are valued on future promises in a currency that is deteriorating. These are essential businesses that provide goods and services people cannot live without and can raise their prices ahead of inflation. Think of global fertilizer companies, defense contractors, certain segments of healthcare, and critical infrastructure. Their earnings will be nominally rising even in a stagnant economy, providing a measure of protection. Fifth, and this is critical, you must internationalize a portion of your assets. The coming storm is centered on the U.S. dollar system. Do not have all your wealth trapped within its jurisdiction. Consider holding some of your gold in Singapore or Switzerland. Consider equities in markets that are commodity exporters, like Canada, Australia, or Brazil. Consider currencies of nations with stronger balance sheets, though be wary, as all fiat currencies will suffer in this race to the bottom. The goal is diversification of political risk. Finally, you must have liquidity. This seems contradictory, but the coming volatility will create moments of extreme panic and extreme opportunity. You must have dry powder in the form of treasury bills or cash, not to hold for years, but to deploy when the markets convulse and assets are thrown away in fear. This is how you upgrade the quality of your portfolio during the storm. This is the implementation plan. It is a plan for war, a financial war for preservation. Start tomorrow. Do not wait for the crisis to be on the front page. By then, the price of silver will have already moved, the doors to physical metal will be closing, and the panic will be setting in. Be the calm one. Be the prepared one. Like Richard the engineer, you must now apply new, tougher mathematics to your financial structure. The constants have changed. Gravity in the financial world has been reversed for decades by the magnet of debt creation. That magnet is now switching poles. The gravitational pull of reality is returning. You have a choice. You can be a spectator to the greatest wealth transfer in history, watching from the sidelines as your purchasing power evaporates and your future is rewritten by forces you did not understand. Or you can be a participant in your own salvation. This is not a prediction. It is a propagation of cause and effect that is already in motion. The debts have been incurred, the money has been printed, the trap has been sprung. All that remains is the sequence of events and your position within them. 120 days. The countdown is not just for silver, it is for your awareness, for your preparation, for your decisive action. The machine is turning. Make sure you're on the right side of its gears. Good night and good luck.